Let's make a start. Welcome to today's ISM webinar on basic income tax. And it is going to be pretty basic. The plan is to start taking you through the fundamental rules of tax for about half an hour. And then the second half of the webinar will concentrate primarily on self-employment and particularly on the expenses which you can set against your income. You should all have had an email from me a couple of days ago. If you do want to ask questions, by all means put them to me during the webinar, but it may well be that those questions aren't terribly relevant to a lot of the people that are tuned in today, in which case do feel free to send me an email after the webinar is finished, and I will, over the next few days, and assuming there aren't too many of them, work my way through them. I hope not to get anything that's horribly complicated. If I do, it may take me a couple of days to get back to you. Could I also remind you of the ISM 24-hour tax helpline, which is available, of course, for ISM members only. And if you are not an ISM member and you've got something out of today's webinar, then do please think about joining us. Not only do we provide you with an extraordinarily good service at the ISM, but you're also joining a group of musicians which does a lot for the profession. www.HMRC, Her Majesty's, because she still owns it, Her Majesty's Revenue and Customs.gov.uk, www.hmrc.gov.uk. It's a pretty good website, but it takes a little while to get around. Okay, here we go. So most of you will know that the UK fiscal year, that's the tax year, ends on the crazy date of April the 5th. Many countries like China and Russia and France have a fiscal year which finishes on the 31st of December. But being British, we have a year which finishes on April the 5th. And if you want to go and look on Wikipedia and elsewhere, you'll discover that as a result of Pope Gregory, Julius Caesar, George I and George II, Napoleon Bonaparte and William Gladstone, all who had a hand in the UK arriving on this rather unusual date. So we are currently in the tax year called 2014 to 15. It started on the 6th of April a couple of months ago and it ends on the 5th of April next year. And in this year, you are allowed to earn, before you are liable for income tax, exactly £10,000. That's called the personal allowance. Pretty well everybody is entitled to that amount, £10,000, which is the personal allowance for 2014 to 15. The figure last year, that was the tax year ending on the 5th of April 2014, easy to remember for musicians, 9,440, 9,440. Or if you're a baroque player, the rumour was that you only got 9,336, but that's a technical joke for those of you who are orchestral musicians. Last year, the personal allowance was 9,440, so if you earned less than that in the year ending 5th of April 2014, you had no tax liability. Not everything is taxable. Let's give you some examples of things where you have to pay tax. Grants and scholarships.
Yeah, if you click up here, that mutes your mic.
Right, are we back on? Okay, sorry about that. So, grants and scholarships aren't taxable. Prizes which you receive from the institution at which you are a full-time student aren't taxable. Somebody asked me a while back, are prizes for general competitions taxable? Yes, of course they are. If you were, for example, a golfer or a tennis player, all your income would be from prizes. So if you enter a prize and you win 10,000 euros, then that is taxable income. But there is an exception for prizes which you win as a student from the place at which you are a full-time student. Gifts, if people give you money, parents, friends, general supporters, as it were, there's no tax to pay on that. And there's also no tax to pay on money you inherit. That is taxed at source under the inheritance tax rules, and by the time it gets to you, it's probably been taxed 3, 4, 5 times already. So if your great granny dies and leaves you £5 million in her will, believe it or not, there is no tax for you to pay. Pretty well everything else is taxable, and there are, importantly, no special rules for students or young people. If you're a 10-year-old genius and you're making a fortune already, you pay tax in just the same way as everybody else. So once you go above your £10,000 threshold, you pay tax at the basic rate, and the basic rate currently is 20%. That's 1/5. You still, of course, keep your £10,000 tax-free. So in the unlikely event that you were to earn, let's say, exactly £10,001 this year, you would be £1 over the personal allowance threshold, and you would have a 20p tax liability. And believe it or not, they would send you a bill and they would expect you to pay it. That 20% threshold applies to the next £31,865 worth of your earnings. So if we add on the 10,000 to that, that means going to higher rate tax when you go above £41,865. And at that point, you hit the first of the higher rates and you start to pay tax at 40%. When you become a high earner, and for tax purposes, that's more than £100,000, other scary things is every time my screensaver comes on, I lose you. So let's see how we go. If you can't hear me at any stage, do just send us a message and we will adjust something at this end. So, national insurance is completely different from income tax. Why do we have two systems? If you pay tax and you pay national insurance, the money goes to the same place. It all goes to the same government department. In theory, national insurance is meant to pay for two things: the state pension, which most of you will get eventually, and the National Health Service. Why do we have two systems? It's largely for political reasons. You will hear government after government announcing to potential voters that they will never increase income tax. And it's very true. Very few governments have increased income tax in recent years, but the national insurance rates have gone through the roof, but they never talk about that. So how does national insurance rates affect you? The problem is that national insurance starts at lower rates than income tax. There are basically four different types of national insurance. If you're employed, you'll pay what's called Class 1 contributions, and they are 12% of your earnings above a basic threshold of £7,956. That's roughly £153 a week. If you're in a job and you're earning less than £153 a week, you won't pay national insurance. Once you go above that, then the excess above that amount is charged at 12%. Class 2 is for self-employed people, and that starts at an even lower threshold, £5,885. Once your income from self-employment is above £5,885, you're liable for Class 2 national insurance, and that's a fixed weekly contribution of £2.75. It doesn't sound very much, but if you are self-employed, hold on for a moment. Then my screen's just got on, I've gone off again, and Rebecca, I'm assuming we're okay. Right, we are, good. Not to worry about that. That's for people who aren't earning anything but still want to maintain an entitlement to their state pension. Class 4 is also for self-employed people, and it's 9% of your profit above that Class 1 figure, again, £7,956. So if you're self-employed, you start paying when your profit goes above 5,885, the basic contribution of £2.75 a week for your Class 2, and in addition, when your profit from self-employment goes above 7,956, they will also do you for 9% of your profit. It's therefore quite possible, of course, to have a national insurance liability while you don't have a tax liability. So although that personal allowance figure of £10,000 a year is very important, it doesn't necessarily get you off the hook. And particularly if you're self-employed, you need to keep an eye on that lower threshold of £5,885. So how does the tax office get its money out of you? There are lots of different types of income tax. There's income tax on investments, there's income tax on property, there's income tax on employment, which is one of the things I'm going to talk about in a moment, and that's going to be very relevant to a lot of you here, full-time or part-time employment. And there, of course, is income tax on self-employment, which we're going to concentrate in the second half of this webinar. Now, let's look at employment first of all. Employment, whether it's full-time or part-time, is, I suppose, defined by a two-way relationship. You, as an employee, you have to do the work that you're given. You can't take time off when you don't fancy going in. You can't ring up on a Wednesday morning and say, I've had their offer. You can't send a friend in to cover instead if you don't want to do the work yourself. You are committed to turning up at your employer's place of business and doing the work that's given to you. In return for that, you get normally a salary, and that salary is payable to you regardless of whether or not there is actually any work for you to do. So if, let's imagine you work in an office and you turn up on a Monday morning and there's no work sitting on your desk, you can sit around, have a cup of coffee, go for a walk in the sun, but you still get your salary. And you still regularly hear that expression in relation to industrial companies, that employees have been laid off. If a car company has produced too many cars and they're all sitting outside in store, they don't need any more cars produced, so everyone gets sent home to do some gardening, but they still get their salary. That's the essence of that two-way relationship. You turn up and do the work that you're given. You've got to be there. You can't choose not to come in, but in return for that, you get a salary. Now, under this system, the employer effectively becomes a tax collector. There's a system in place which many of you will have heard of called PAYE. PAYE stands for Pay As You Earn. It's all done online these days. There's a system which has come in over the last couple of years called RTI, real-time information. Every time your employer makes a payment to you, he has to notify his tax office online, and all the tax is now calculated remotely. So if I, as an employer, were to how to calculate your tax. So, for example, if you were, let's say, conveniently on an annual salary of £24,000 a year, you might expect, with some justification, to be receiving £2,000 a month. But when your paycheck turns up, you discover that there's probably no more than about £1,200 or £1,300 there, because the income tax and the national insurance and probably a few other bits and pieces as well have all been whisked away by your employer and sent off to the tax office. It's quite a good system. And in theory, it can't go wrong. In theory, NB, and do make sure that if you're on the PAYE system, if you don't understand how it works, get someone to check it for you. At the end of the tax year, April the 5th or shortly after, you'll find yourself given a certificate called a P60. That P60 has all the information on it about what's happened to you tax-wise over the last 12 months. Your name is there, your employer's name is there, the name of the tax office that's got your money is there, and it tells you how much you've earned in the last 12 months, what tax code you're on, how much tax has been taken off. And that is your proof that your tax liability has been paid for that year. A copy of that P60 goes off to the tax office, they check the figures, and assuming that nothing has gone wrong, that's the end of the story. PAYE codes are a bit of a mystery to people, but actually they're terribly straightforward. All that you've got is a number which says to the employer how much tax you are allowed to earn before the tax deductions start. But for some peculiar reason, the last digit is taken off. So most people working in the current tax year have got a tax code of 1000. That basically means that they are allowed to earn money up to £10,000 before they have a tax liability. Last year, most people were on tax code 944. £9,440 was the personal allowance. There's usually a letter stuck at the end of it. Typically, it's an L, which means entitled to the basic lower rate of personal allowance, which is slightly ironic because they've just abolished the higher rate of personal allowance, so pretty well everybody is on L these days. Now, the advantages of PAYE are twofold. Primarily, you can spend the money you get. You haven't got to worry about saving up to pay tax bills later on. So you get your money. It's a bit unfortunate the tax office have run off with a rather large proportion of it, but you can spend it without having to worry about saving up for later on. The other big advantage is that in general, you haven't got to worry about filling in a tax return or any other tax paperwork. The only pieces of paper you see from the tax office are your PAYE codes, and typically there'll only be one of those a year. And the only other piece of paper you get apart from your monthly or weekly pay slip is your annual P60, or if you get sacked or lose your job and move on, you get another form called a P45, which effectively transfers the system onto the next employer that you work for. Disadvantages? Well, I suppose it would be nice to see the money just for a moment before the tax office run off with it. If you earned £24,000 a year, I suppose it would be quite nice just for a moment to see £24,000 a year, but that's not the way it works. The biggest disadvantage, though, is that in general, if you are employed, if you've got a job, you are taxed on that salary. In general, you can't deduct expenses from your salary before your tax is calculated. So it's no good telling your tax office that it cost you £2,000 to travel to and from work last year. Doesn't affect the amount of tax you pay. There's no point even saying that you subscribe to a regular journal of a learned organisation which helped you to do your job better. No, it makes no difference. I'm going to quote one and probably the only piece of tax legislation to you now, which is this. If you want to claim expenses against your employment, and remember this only relates to employees, then that expense has to be, and here's the quote, wholly, exclusively and necessarily incurred in the performance of your duties. I'll say it again, it's a bit of a mouthful. Wholly, exclusively and necessarily incurred in the performance of your duties. Now, the Americans would say, let's unpack that. Let's look at the second half of it. In the performance of your duties, that means while you're actually working, not on the way to work, not on the way home afterwards, not during your lunch break. The expense actually has to be something that's relevant to the time you're actually in your job, doing your work. Wholly, exclusively, and necessarily. Now, the crucial word is necessarily. You can only claim an expense if it's necessary to your job. And HMRC, the tax office, really go for that word necessary. For them, it means that if you can do your job without that expense, it's not necessary and they won't allow it. The fact that it might be helpful, desirable, useful, or anything else, as far as the tax office is concerned, is completely irrelevant. If you can do the job without the expense, then it's not necessary and you can't claim it. There's one important exception, and that's that everybody, whatever they do, is allowed to claim a subscription to a professional organisation which is relevant to their work. And of course, your ISM subscription, if you are employed, is a relevant subscription. HMRC keeps a list of approved bodies. The ISM is one of those bodies. So if you're listening today and you've got a full-time job, you can claim your ISM subscription as an allowable expense. And if you need to know how to do that, send us an email afterwards and we'll explain what you need to do. If you haven't been doing it in recent years, you can go back for 4 years and claim the allowances that you've missed. But that can be included in your PAYE code number, which would mean that your code number would go up from 1000. It would be increased to include your ISM subscription, which means you pay slightly less tax. The only other expenses, as I say, which are allowable when you're employed are expenses without which you could not do your work. There is an instance here where many professional musicians can claim, and that's orchestral players. who of course have to maintain their instruments. They couldn't do their job without that, and also have to wear concert clothes which aren't provided by their employer. So let's imagine that you are an employed member of the Halle Orchestra and you play the violin. The cost of buying your strings, getting your bow re-haired, getting your fiddle occasionally overhauled, and the cost of your tails or your long black would be an allowable expense, because if you turn up for work without those, you cannot do your job, and therefore those expenses are considered necessary. Let's give you an example very quickly of how strictly that rule is interpreted. I've got a client who is a cellist, and she works full-time for a local authority, employed as a peripatetic teacher. And she asked if it would be acceptable to claim the cost of maintaining her cello, keeping a cello in good order, against her tax. It seemed perfectly reasonable. So we calculated how much cello maintenance had cost over the last year, and we sent a claim into the tax office. And the inspector wrote back and said, "Is the cello necessary?" So we thought, well, I mean, she's a cellist, she's teaching the cello, so her cello is necessary. So they wrote to her employer and they said, if Miss X came into work to teach for a day without a cello, what would you do about it? And the employer replied that they had three options. They could lend her a school cello out of stock, or while she was teaching, she could borrow her student's cello and demonstrate on that, or she could do what some of their teachers did, which was to teach only verbally and not actually demonstrate the cello. And I've just had a little sign saying I've got 12 minutes left on my battery here, which means I'm probably not plugged into the mains somewhere, so you might like to look at that. I'm going to keep talking and see what happens. And they said she can't claim it. The cello is desirable, but it's not actually necessary, so we couldn't claim. Now, a few weeks later, she called me again, and she said, oh, my job's changed. So I said, what's happened? And she said, well, I've just been given the job of playing with my local authority's staff string quartet. She said, we go around to schools and we put children off Mozart. I thought that was a bit unfair. But anyway, she said, does that make a difference? And I said, well, absolutely it makes a difference, because you can't now turn up for work without your cello. So we wrote back to her tax inspector and said, been a change in our client's contract. She is now a member of the string quartet, and we consider that her cello is probably necessary now. So the tax office wrote back to the employer once again and said, what would now happen if your employee came along to work to play in a string quartet with no cello? And very kindly, the employer wrote back and said, we'd probably fire her, which is exactly the result we wanted. So I had a lovely letter from the tax office saying, we are delighted to inform you that your client's cello now appears to be necessary, and we will allow the cost of maintaining that cello as a deduction against her income tax. So that's how strictly that word necessarily is interpreted. Now, self-employment, a totally different setup. The rules are basically the same, whether you are a self-employed individual or whether you're a multinational company. There is no salary, and you are taxed on something which you hope you're going to make, which is a profit. Profit, in very, very simple terms, is defined as business income minus business expenses. Let's look at a non-musical example for a moment. Let's imagine you're running a restaurant. Now, it would be totally unreasonable to calculate the owner's tax liability just by looking at how much money he collected from his customers every night, because out of that money, he's got to buy his food, he's got to pay his waiter, he's got to have his menus printed, he's got to pay rent for the premises, he's got to buy tables and chairs, and so on and so on and so on. And after he's paid out all those things, with any luck, he'll have a bit of money left over. That's the money he takes home. That's his profit. So he's taxed on that. He's not taxed on all the money that comes in from his customers. Now, there are very, very big differences, therefore, in the tax treatment when you're self-employed. Obviously, PAYE can't work. For those of you who have private pupils, just imagine what it would be like if the tax office sent them all a PAYE code number and instructed them to deduct 20% of your fee every time they came and had a lesson and asked them to send it along to the tax office. It's completely impractical. So that means that the tax bill's going to come in later. And it can come in a lot later. I mean, typically, you're earning your money and paying out your expenses in year number 1. In year number 2, you're doing your accounts and filling in your tax return. And in year number 3, you're paying out the tax on what you earn in year number 1. Now, that's a long gap. And that means that you need self-control when you're self-employed. You've got to save money and put it to one side. And that can be really, really difficult if you have a very, very good year followed by 2 very, very bad years, because of course the tax bill for the good year is going to come in the second bad year, and it's no good telling the tax office that you've spent it because you ran out of cash. Self-control when you're self-employed is absolutely essential. The second big difference relates to the expenses you can claim. And let's go back to that little bit of tax legislation, that wholly, exclusively and necessarily rule which applied when you were employed. If we go to the same bit of legislation for self-employed people, the regulation says that the expense has to be wholly and exclusively in connection with the business. And that word necessarily isn't there. Now, why isn't it there? Well, quite simply, it's impractical. Just imagine a tax inspector coming along to my restaurant and trying to define which items I had purchased were necessary and which were only helpful and desirable. Right, you've got flashing lights in your window. You don't need those. You could run a restaurant without that. You've got a clock on the wall. Why do you need a clock? I'm sure all your customers know what the time is. You've got wallpaper, but I'm sure you could manage it here, No, it's impossible. You can't do that. When you're in business, it's your job to make as much money out of your business as you can, and you don't want the tax office interfering in that process. So necessary? No. All you have to do is to prove that the expense is actually relevant to the business you're running, which is a very, very different kettle of fish. So as we come up to the halfway mark, let's just summarize the main differences between employment and self-employment. If you're employed, part-time or full-time, you are effectively on a salary and you are committed to your employer to carry out the work that you do. If you're self-employed, you haven't got a salary. You're making a profit, you hope, or you may even be making a loss, and you have no contractual relationship with any one individual. If you're employed, your tax is paid through the PAYE, pay-as-you-earn system. It's whisked away at source before you even see the money. If you're self-employed, all the money you earn comes to you. You are paid what is called gross, and that means that later on, your tax bill is going to be payable. If you're employed, the chances are that you won't need to fill in a tax return every year. It's all dealt with for you in the background. If you're self-employed, you're going to have to prepare accounts. You're going to have to file a tax return with the tax office by the 31st of January every year. And generally speaking, you're going to be paying your tax direct to the tax office. And as many of you will know, when you are self-employed, your tax is usually payable in 2 installments each year. One on the 31st of January, just when you're completely flat broke after Christmas, and the other one on the 31st of July. I make a mental note here, that's only in about over a week's time, when you were thinking of having a summer holiday and suddenly discovered it after all. And when you're employed, you can only deduct expenses which are absolutely fundamentally necessary to enable you to carry out that employment. When you're self-employed, all your business expenses are deductible from your income before your profit is calculated. The tax office can't even say that the expenses are too expensive. You choose how much you want to spend on your business expenses. If, for example, you decide to travel to your venues by first-class rail, they can't come back to you and say, but you could have done it cheaper by going standard class. No, if you choose to spend all your income on tax allowable expenses and wipe out your profit completely, then you would pay no tax whatsoever. But of course, you'd be flat broke, so perhaps it's not such a good idea after all. Incidentally, as many of you will know, it's quite possible to be employed part-time and self-employed at the same time, and the rules will apply to whatever you happen to be doing on the day. So if on Monday you have a part-time job in the school, the employment rules will apply on that day. And if you're self-employed for the rest of the week, it's no good going to your school bursar on Monday and saying, but I've got self-employed status, because that will only apply from Tuesday to Sunday. Monday, you are employed, and the rules will apply to employment on Monday, regardless of the fact you happen to have self-employment status for the rest of the week. Now, I'm getting messages saying, why does the sound keep cutting off? Is there a problem generally with us, or are we doing all right now? Let's see how we're doing. And we are now at 1:20 and I'm going to drink a quick sip of water here. I'm just going to ask Rebecca just to check the system's working okay. Rebecca, are we doing all right here?
I think that's an old message.
Right, that could be an old message. Let's assume we're okay.
Yeah, it's an old message. Fine.
Right, we think we're okay. Everyone's saying yes, which is looking really, really encouraging. Now, I'm going to keep going because, as I said earlier, if I take questions now which are relevant just to one or two of you, then it's going to hold things up for the rest of us. So please do send in questions after we finish in about half an hour's time, and I will deal with them personally for you. It also means you'll get a much better answer to the questions than if I try and give you a very, very quick answer while the webinar is in progress. So that basically summarizes the difference between employment and self-employment, and also explains to you the basic tax rates, the basic national insurance rates, and how the tax is collected from you. Let's spend the rest of the half an hour that we've got concentrating on self-employment and the expenses which you can claim. And one of the questions that everybody poses when they first become self-employment is, well, what are the expenses that I can deduct from my earnings before my tax bill is calculated? I knew somebody who actually telephoned the tax office helpline to ask exactly that question. It took about 10 goes to get through, and they ended up sitting on the phone for about half an hour, but eventually they got through to a tax specialist. And my friend said, I've just become self-employed as a musician, and I would like to know which expenses I can claim. And the tax consultant said, you can claim any expenses which are wholly and exclusively in connection with your business, but they don't have to be necessary. So my friend said, no, that's not what I mean. I mean, which expenses can I claim because I'm a musician? And the tax expert said, well, you need to consult your professional body about that, or possibly speak to an accountant. And that was quite right, because it's not their job to give you specific guidance on the expenses which you can claim as a musician. And no two of you will have exactly the same professional circumstances. It's your business. You claim the expenses which you consider are relevant to that business, and it's not for the tax office to tell you what they might be. Interestingly, if you go onto the ISM's business pages, you'll find there is a list there of expenses which you may well be allowed to claim against your tax when you're self-employed. Those of you who are also members of the Musicians Union will discover that the MU sends around a handbook every year which has a list of expenses that you can claim as a self-employed musician. That list is different from the one that the ISM publishes, and the MU one regularly says you may not get this, or your tax inspector might dispute this. If you're a singer and you join Equity, you'll find they also produce a list of expenses that you can claim as a musician, and that list is different again. There is no official list. Years ago, back in the 1960s and early 70s, when I was training to be an accountant, before I decided that music was a much better option, the tax office is used to examine every single set of accounts that was sent in, and they would come back to you or to your accountant with a list of questions. Those days have long gone. Nowadays, you send in basically three figures. You send in the total of your income, you send in the total of your expenses, you send in the profit, which is one minus the other, And that is basically all the tax office get for the vast majority of people. It's totally computerized, and they are not even going to be bothering to check what you're claiming unless your figures look so different from everybody else's in your profession that the computer throws up some sort of warning. There are practically these days no inquiries into self-employed people. The tax office have got hardly any staff left after the cuts over the last few years. They occasionally put together a task force where they try and go for people where they think there is serious tax fraud. And interestingly, the very second task force the tax office put together a couple of years back was aimed at private music teachers. I wonder why that might be. So here is my list of the expenses which I would expect you to be claiming as a self-employed musician. But this list is not official, it's my list, and once we get to the end of it, I'm sure you're going to think of things which you can add to the list for yourself personally. Some of these are obvious. I mean, let's start with sheet music and books on music. They will all be claimable. You don't need to prove that you're performing the music. If you went out and bought Grove's Dictionary or the complete works of Bach, you wouldn't need to prove that you were an academic. You wouldn't need to show that you were a Bach specialist. It's obviously relevant to your profession, and so that would be completely claimable. As would be recorded music. You might be buying CDs or DVDs, or you might be downloading music. Please do it legally, by the way. You'll be getting nasty emails if you do it illegally over the next 12 months. That will all be completely allowable. Again, you don't need to prove that the CD you bought is a piece of music you're intending to teach or perform. Instrument maintenance and tuning, that's an obvious one. You've got to keep your equipment in good condition. The same would apply if you had a repair done to your audio system or your computer. All business repairs to and the maintenance to your equipment will be allowable. Money paid to other musicians. You might employ an accompanist, you might employ a repetiteur or a coach, or you might send a deputy in to cover your West End show. You might send a deputy in to cover your self-employed teaching. The cost of paying those other musicians would be a business expense. Travel. Now, here's an interesting one. You're allowed to claim the cost of traveling between places of work. But as a self-employed musician, you are working from home. And in almost all circumstances, home counts as a place of work. So the cost of traveling from home to a concert venue or a venue where you are giving private lessons, not where you're employed, of course, traveling to a meeting, traveling to your music shop, traveling to your repairer, traveling to see your accountant. All this travel is allowable. And as I said earlier, they can't tell you how to travel. If you want to fly or go by first class rail fare or whatever it happens to be, they can't come back to you and say it was too expensive. The only travel they will not allow is travel to a regular place of work. So let's imagine that you are a musician and the only work you do is for a show in a West End theatre. The cost of travelling from home to that venue every night would not normally be considered allowable. If you travel by car, then you've got two options. You can either claim a proportion, the business proportion of all your car's running expenses. So let's imagine your car does 10,000 miles, of which 8,000 is related to your self-employment. Then you would claim 80% of all your car running expenses. Or as an alternative, there are fixed mileage rates which you can claim. Basically, it's 45 pence a mile for the first 10,000 miles of business travel a year, and then reduced rates apply when you go over the 10,000 mile threshold. Hotel expenses, bed and breakfast. If you need to stay away overnight, then the cost of hotels, bed and breakfast is allowable. And the cost of meals when you're working away is also allowable. And interestingly, the rules have actually become a little bit more generous on meals recently. They used to allow meals only when you were working away with an overnight stay. That's improved. Basically, if the cost of travel is allowable, then the cost of the meal you have when you're working is allowable as well. So if you are a true freelance musician, if you're traveling around from place to place to place, then the cost of meals while you're away from home can be set against your tax. That doesn't mean, incidentally, that you can have a rehearsal at home with your quartet. go round the corner and have a slap-up meal in the local Indian restaurant with half a dozen glasses of wine and charge that up against tax. That is not a business meal. But if you are travelling around from place to place as a freelance musician, then the cost of the meals that you incur are now allowable for tax. Concert clothing, special clothing is allowable, but it has to be special clothing, not the sort of clothes that you would wear standing in a bus queue without getting raised eyebrows. In no circumstances can you claim the cost of clothes that you wear when you're teaching, and looking smart or pretty for an audition isn't allowable either. So these have to be clothes which you wear for, generally speaking, public performances. Now, for the blokes, that's fairly easy to define. It's tails and it's dinner jackets and it's white tuxedos and it's frilly shirts and it's bow ties and cummerbunds. For the ladies, it's a little less easy to define, but I suppose we're looking at things like long black dresses and long coloured dresses and so on and so forth. So it's important that this is not everyday wear, and it's also important that these clothes are purchased exclusively for concert use. That is one of the conditions. So special clothing is allowable, and therefore the cost of dry cleaning, washing those clothes would be allowable, as would be the cost, I suppose, of having them repaired as your fans at the Wigmore Hall try to rip your clothes to shreds as you leave the platform after playing in a Mozart string quartet. Unlikely for us. Hairdressing and cosmetics for public performances. If you're doing a solo performance at the Royal Albert Hall and you have your hair done specially, then that would be an allowable expense. Let's go for some obvious ones. Telephone, landline and mobile, your broadband subscription. Again, rather like the car, a proportion of those expenses will be allowable. Especially in these days of itemised bills, the tax office, if they looked at your records, could see what you were spending your money on. And if you've got a boyfriend in, let's say, the USA, and there's a daily phone call to the USA, then a large proportion of your phone bill is probably not going to be related to your work as a musician. I suppose, on the other hand, if your boyfriend happens to be an agent in the USA offering you work, you might get away with it. So we're going to be looking at a proportion of your landline, mobile, and broadband expenses. And it's up to you to work out that proportion, what that proportion is going to be. The tax office might ask you how you've calculated it, but they're not going to be expecting you to keep ludicrously detailed records of every telephone call you make. If you're an orchestral musician and you've got a diary service, an answering service, then the cost of that, again, is an obvious business expense. Instrument insurance and insurance on other business equipment which you happen to use at home. And incidentally, may I just say that if you don't have insurance on your business equipment, please do get it. If someone breaks into your house and steals your instruments and you're uninsured, that can be the end of your career. And I know a couple of musicians where it has quite literally been the end of their career when something's actually happened to an instrument and it's not been insured. A friend of mine drove over his Strad last year. It was not a good thing to happen. Fortunately, he was insured. Again, some obvious ones. Postage, stationery. They may not seem like big expenses, but if you're printing out a lot of stuff on your computer, the cost of ink cartridges can be horrific. Postage and stationery. Advertising costs. This can include having your photo done, having a brochure prepared, maintaining your website, web hosting. So anything to do with press and publicity is an allowable business expense. Music journals. You might be subscribing, I don't know, to Classical Music Magazine or whatever, Opera Now, Opera Tomorrow, Opera the day after next. Any music magazines you happen to sign up for, perfectly reasonable. You may be buying the Radio Times to see if your broadcast has appeared on the Radio 3 schedule. You may be buying the Times or the Guardian or the Telegraph or whatever to see if there's a review of your concert last night. Absolutely acceptable business expenses. Professional subscriptions. Certainly your ISM subscription, any other professional body or union you happen to be a member of, which enhances your understanding of the music profession, perfectly acceptable. And in those cases, those subscriptions don't only have to be for organisations which are registered with the tax office as suitable professional organisations. Your accountant's fee, that effectively reduces your accountant's fee by the basic tax rate, 20% saving on your accountant's fee. And if you haven't got an accountant, you're doing it yourself. Can I just say as an aside here, please do think about that. I was talking to a colleague last year who said, oh, he said, you work as an accountant as well as a musician, don't you? So I said, yeah, absolutely true. And he said, I've saved myself a fortune over the years. He said, I've never had an accountant. He said, I do it all myself, and I bought a book on it. I said, what's the book called? He said, it's called Teach Yourself Accountancy. And I thought, great. I said, how do you know you're getting it right? Well, he said, I've never had any bother from the tax office whatsoever. So I said, well, it might be because they're delighted by the amount of tax you're paying. They're hardly going to ring you up and say, you're giving us far too much money, are they? And he said, well, hadn't really thought about it like that. So I said, look, I'll tell you what to do. I said, bring me in your records for the last couple of years and let me have a look at what you're doing and how much tax you're paying. And if you're doing it right, then I'll come back to you and say, brilliant, you're absolutely right. You're saving yourself a fortune. Carry on doing it. You're doing a wonderful job. But if I can find some areas where you've maybe misclaimed or some bits of legislation that changed without you realizing it, then we'll do a little tax claim for you and see how much money we can get back. And I'll charge you for doing that, but I won't charge you more than the tax refund. He thought about it for a moment. He said, that seems quite a good deal. So I said, yeah, I just want to prove something. So I saw him a couple of days later and he brought in a few carrier bags and a couple of shoe boxes full of receipts and bits of paper. And I took it away and went through it. He wasn't doing a bad job, but there had been changes in legislation that he wasn't aware of and a few things he wasn't claiming that he could have claimed. And we got back, it was just over £2,000 for him. And I charged him about £250 for doing that. And yeah, he wasn't doing anything wrong, but he wasn't quite doing it right. And I'm now doing his accounts for him every year. Now, what's the rule there? Music is a profession. You know that. You know how long it took you to train, how long it took you, even after you'd finished the training, to become what you might call a skilled professional. And accountancy and tax is just the same. Yeah, you can learn the basics by buying a copy of the Idiot's Guide to Income Tax, but it doesn't actually teach you all the specialist rules that you need to know. Yeah, you may be saving yourself some money by doing it yourself, but just check that you really are doing what you're supposed to be doing. If your accountant is not saving at least the equivalent of his fee every year, then there's something wrong. You ought to be looking for a specialist accountant, preferably relating for a medium-sized or small company, somebody who understands the music profession and someone who takes a real personal interest in saving you tax. That's what you need. Certainly not someone who's going to do anything illegal. Certainly not someone who's going to put you onto one of these illegal tax-saving schemes. But somebody who says to you, did you know you can do this? Or did you know you can do that? Or did you know you can save a bit of money if you claim this? So that's what you need. So if you are doing it yourself, fine. But just check you really are doing it in a way which is saving you money. It may not be saving you quite as much money as you think. And of course, as I just said, your accountant's fee is an allowable fee for tax expenses. So that means it's deducted from your income before your tax is calculated. And for most of you, that means that 20%, and if we take into account the national insurance, more like 30% of that tax, that accountant's fee comes back to you as a tax saving. On we go. Solicitor's fees. You may end up engaging a solicitor to help you get money back from an unpaid contract, or possibly for helping you to draw up a contract when you're taking on a new job. That would be allowable. Conference and seminar fees. If you attended the ISM conference earlier this year, then the money you paid in attending the conference, including the cost of the hotel and the meals, if you have bought any for yourself, will be an allowable expense, and that's deductible from your income as well. Loan interest. Here's an interesting one. If you borrow money to buy equipment or to buy an instrument, whatever it happens to be, then the loan interest that you pay is tax allowable. One word of warning here, they won't allow interest on an overdraft. So if your account just goes overdrawn because you've bought a new flute, you can't claim that interest because you can't show that it was just the flute that made you go overdrawn. Neither, generally speaking, can you claim interest on a credit card because, once again, that credit card is going to have various other items on it, and you can't show that the interest relates specifically to the item that you've bought. So if you are going to borrow money to buy business equipment, instruments specifically, make sure that money is separated. So you take out a bank loan or you take out a credit arrangement or whatever, so that you can say this interest relates very specifically to the money I'm buying, the money I'm borrowing to buy that item of equipment. Using a room at home for business purposes. Now this can be quite a lot of money. If you have a room at home in which you teach, or maybe in which you even just practice, then that room is used partly for business purposes, and the cost of maintaining that room is an allowable expense. That means for most of you that a proportion of your rent or your mortgage interest, a proportion of your council tax, a proportion of your gas, electricity and home insurance is allowable against your tax. Now, how's it calculated? Well, it's up to you to do the calculation, but broadly speaking, it's like this. Let's imagine that you've got a house with 6 rooms in it, and one of those rooms is used almost exclusively as your music studio. Then we're going to say, okay, 1/6 of your house expenses relate to that room, and maybe that room is used mostly, let's say 75% for business purposes, so 75% of 1/6 of all your house costs will be allowable. Let's imagine you've got a much smaller property. Let's imagine you've only got 3 rooms and you do a bit of teaching in your living room. So we're looking at 1/3 of your house costs, but maybe only 10% of that use of that room will be allowable. So we'll be looking at 10% of 1/3. If you've got a bigger room, let's say a bigger house, let's imagine you've got 10 rooms and one room is pretty well exclusively a music studio, then we'll be taking 1/10 of your house costs and maybe 95% of the costs of that one room, 95% of 1/10. It's not a good idea, incidentally, ever to say that one room is used exclusively for business purposes. That can get you into trouble with capital gains tax when you sell your house later on. So even if you only go into the room and read the newspaper once a week, that's enough to prevent that problem happening. But I would recommend never claiming more than 95% of use of one room for business purposes. And of course, that room is effectively your shop, your restaurant, if you like. That room needs to be kept in good decorative order. So once again, looking at decorating costs, soft furnishings, carpets, curtains, whatever, a proportion of those costs for that room would also be considered allowable by the tax office. On we go. Oh, come on. I think by this stage, you're getting the hang of it, I hope. The way to do this, you know, is to say to yourself, every time you spend any money, can it somehow be related to your profession as a musician? And nearly every time you'll find that the answer is yes. Okay, you can't claim the cost of the clothes you're wearing at the moment, unless you're on the way to a concert. You can't claim the food you eat at home and the food you eat when you're going out with friends. You can't claim for the cost of your holidays, although, of course, if you happen to drop in on a music course or go to a concert while you're there, you may find a proportion of that would also come into it. You can't claim gifts you give to friends and relations, but pretty well everything else when you're self-employed as a musician will somehow relate to your work. Now, all these expenses I've talked about so far are straightforward running expenses. They're day-to-day expenses. On top of this, you are going to be spending money on larger items, equipment. Equipment, I suppose you can define as something which has a resale value, and there are different rules here. Expenses are claimed as a deduction using a system called capital allowances. And in previous years, you haven't been allowed to claim equipment against your income in the same way as other expenses. At the moment, you can. There is something in existence at the moment called the annual investment allowance, and that means that you can claim the cost of equipment in every tax year up to the value of £500,000, and this should keep most of you very happy, £500,000 just like any other expense. So if you go and buy a violin and it costs you £10,000, you can just deduct that £10,000 from your income in the same way as any other expense. But there are other differences, and they're important ones. The first one is you don't have to claim these capital allowances and annual investment allowances if you don't want to. Why would you not want to? There's a couple of reasons. Let's imagine that your profit is already below the £10,000 tax threshold, but you've gone out and bought an oboe for £3,000. Claiming it isn't going to save you any tax because your profit's already too low. So you can choose not to claim it and to store that claim up for a later year. or you can choose to claim just enough to get you off tax. So let's imagine my OBO has made a profit of £11,000, but bought a £3,000 OBO. You claim £1,000 of that OBO just to get you out of tax. And again, you save up the rest of it for later. Incidentally, if you do save it for later, all sorts of more complicated rules come into force, which we haven't got time to deal with now, but you have to then do it as if you'd bought it yourself. So if Granny gives you a piano for Christmas, find out what that piano is worth, and you can deduct it from your tax as if you'd bought it yourself. Thirdly, and this is particularly relevant to those of you who have just become self-employed or are thinking of becoming self-employed in the future, you can claim the cost of all business equipment which you already own at the time of your self-employment's commencement, as if you bought it on day one of your self-employment. So if you are recently self-employed, you go around your house or your flat and you make a list of everything you already own and you claim it at what it's worth on day one of your self-employment, and that can be quite a significant tax saving. So instruments you've already got are claimable, as would be your computer, your desk and your filing cabinet, your audio system, your iPad and your iPod, anything that you're going to be using in your professional work, even though you bought it prior to becoming self-employed, is claimable at the value that it's worth on day one of your self-employment. A word of warning though, if you are thinking of claiming for business equipment, which is actually going to increase in value, then just think about whether it's a good idea to claim capital allowances or not, because when you come to sell that equipment, you're going to have to pay all those allowances back, and the tax allowances you pay back may cost you more than you claimed for them in the first place. Capital allowances are designed for business equipment which devalues over its lifetime. Musical instruments on occasion increase in value or at least keep their value. And in cases like that, it's a good idea to speak to a tax expert to find out whether it's worth claiming or not. You can actually just store up a tax disaster for yourself in the future by claiming, let's say, an expensive violin, which then 20 years later turns out to be twice what you originally paid for it. The tax office have just introduced a simplified scheme for claiming expenses for self-employed people. I would just mention that this simplified scheme is designed to save you time. It's not designed to save you money. And for the vast majority of self-employed musicians, the simplified tax allowances scheme will actually end up with you certainly saving time, but probably paying a hell of a lot more tax. It's not a good system for musicians. Have a look at it if you want to, but generally speaking, I would advise you to steer clear of it and use the more traditional, complicated system which we've been outlining today. We've got just a couple of minutes. Let's finish by asking you a few questions. Why have you needed to sign up for the ISM tax webinar today? Tax is an incredibly important subject, and if you don't know about it, go and get some advice. I've only been able to cover a few basics today. You're going to need more advice than I can give you in an hour, and you're going to need more advice than you can get from one email to me, and possibly more advice than you can get from looking at the ISM's tax pages. Get some professional help. Secondly, if you are running out of time to get your tax done, and particularly if you haven't yet done last year's tax return, then please get it sorted out. The fines are horrendous. Yes, there's a £100 fine for sending in your tax return late, but if it's 6 months late or a year late, it can go into thousands, quite literally, of pounds. And they do come and get the money. These are not optional fines, they're compulsory. Thirdly, remember that if you've got specific queries about your own personal tax issues, send me an email after this webinar is over. And if there's anything you weren't too clear about, you can listen to this webinar again on the ISM's website when it will be available within a week from now. And that takes almost exactly to 10 to 2. I hope this has been of use to you. Do tune in to other ISM webinars in the coming months. And keep in touch. And as I say, if you're not a member of the ISM already, do consider joining. We can help you a lot with tax and various other issues in the future. Good to have been able to see you today as far as I've been able to. Goodbye from Rebecca, who's sitting on my right, and from me, and keep in touch with us. Bye.